Welcome to Biz Help for You with host Candy Messer. Entrepreneurs like to focus on the big picture, like profitability, success, and a smooth-running organization. But there always seems to be those little things like taxes, employee compensation, laws, regulations, and more. Now you can get the answers you need in one place. Join us today as we break it all down for you. Now, here's your host, Candy Messer.
Hello and welcome to Biz Help for You with Candy Messer. Thank you for joining me today. I hope you enjoyed the topic of my last interview. And if you missed the episode and would like to listen to the show, links can be found on my YouTube and Facebook pages, as well as multiple favorite podcast platforms. And if you'd like to receive notifications on when my podcasts have been uploaded, please like and subscribe. Now, let's learn a little bit about our guest today. Norman Pappous, a retired financial markets professional, was motivated to enter the wealth management industry by a personal tragedy. He began his professional career in London, working for global investment banks and hedge funds before coming home to help the average investor navigate the financial markets. Shocked by the misdirection of Wall Street marketing, Norman launched financialadvisorcheck.com, a company that serves the clients of financial advisors by producing, for free, institutional level, confidential portfolio performance reports without the knowledge of their investment advisors. He's been featured in the New York Post, Forbes, Investment News, Registered Rep, TheStreet.com, and Frontline on PBS. So Norman, welcome to the show.
Hi, thanks for having me, Candy.
I'm excited to talk about this topic. It's not one that I have really discussed. We have talked about financial planning and things like that too, but I love the perspective that you're going to be coming from, just to open our eyes a little bit. But before we get into questions that I have for you, I'd love for you to tell me just a little bit more about yourself and what made you challenge Wall Street marketing.
Sure. Well, it actually goes back to, like you said, a personal tragedy. On April 8th, 1986, my brother committed suicide. And that was kind of the culmination of a real difficult time in my family's life that was brought upon us by a very disreputable financial advisor that my dad had hired. And was put into bankruptcy, put the family through heck. And on that night, when my brother took his life, after that, I kind of said, okay, I'm going to make wealth management my career, and this is never going to happen to anybody else. So I went and got a degree in economics, and then I decided I also wanted to get a degree in financial markets. So I got a graduate degree, and I wanted to live overseas. So I went and worked at some investment banks and merchant banks over in London, and did some consulting with hedge funds. And I came back to the States and I met a girl from Texas. So moved down here, and there wasn't a lot going on down here with what my particular specialty was in the financial market. So I said, something, I'm going to put up my own shingle. I'll work for Merrill Lynch. Who wouldn't want to work with me? After having been, at the highest levels of wealth management. And I found out real quick that knowledge and skill are not a criteria for hiring financial advisors. It is very much a sales-oriented endeavor. And the difference that I found in the retail sector and the institutional sector was so stark, it's almost like the two industries aren't connected, even though they invest in the same products. On the institutional side, if I'm managing several $1 billion like a Texas Teachers Retirement Fund, I go out and I put out a request from all these different investment managers saying, hey, send me your record of how you might invest, this $300 million in a small cap value sleeve for my fund, because we have decided we're going to allocate $300 million to small cap value. So you would get a bunch of small cap value investors saying, okay, investment managers, okay, this is our record, this is how we do it, et cetera, et cetera. And the Texas Teachers Retirement Fund would filter all that and then bring them in. And one or two people would be assigned the money. And as the months go by, the Texas Teachers Retirement Fund follows their own account, because they're investment professionals. And as long as the account is performing as was expected from the history of the investment manager, things are great. But If the performance slips, and I'm not talking about returns, I'm talking about performance or risk reward stuff. If the performance slips, the investment manager gets a call. And if the performance continues, the money's pulled. It's business. Now,
Mhm.
contrast that to the people who walk into Merrill Lynch or Morgan Stanley or Wells Fargo or Raymond James. And this is where my head just exploded, because when you look at their performance reports of these financial advisors, that who produces them? The financial advisor, which is kind of like
Mhm.
having a kid grade your own paper, in
Mhm.
class. There is nothing about risk reward. The studies they use would never pass muster in an institutional environment. They would get thrown out of the
Mhm.
conference room. But Wall Street, when it gets down to Main Street, likes to rely on sales skill rather than investing skill. And that is where financial advisor check is going to upset Wall Street, because we're going to turn the flashlight and shine a big bright light on which financial advisors have investing skill and which don't. And we're going to do it with a free app and to the investor themselves, and their advisor will never know. That
Mhm.
said, I always want to tell people we firmly believe a skilled financial advisor is their best asset. People who invest on their own are kind of like the lawyer who represents himself. And what's that saying? A lawyer represents himself in court, as a fool for a client.
Right.
99% of investors shouldn't be doing this themselves. But
Mhm.
you want to make sure you get somebody who's skilled. And, I like to tell people, they say, why shouldn't I do it? I can just put it in index funds. Well, it's not that easy. That's the marketing stuff that that they can put into quick 30-second blips. But here's the thing. If I was to say, I'm going to give two people a chance to lose weight, and I'm going to give one of them a book, and everything in that book tells you how to lose weight. The other one, I'm going to give a dietitian that's going to map out what you need to eat. I'm going to give you a cook that comes over, cooks you 3 meals a day. Then I'm going to give you an exercise coach. Okay. Now, which one of those two is going to lose the weight? It's not going to be the
The
person who read
second.
the book. Yeah.
Mhm.
So absolutely find a good financial advisor that you think you can work with.
Mhm. So if someone is listening, so again, most of my audience is going to be small business entrepreneurs. They're so busy doing, what they need to do to run their own company that they don't have time to really do a lot of research or, figure out what's best. So how do they even determine, like say they got a referral or say they know someone who does financial advising, that they are a good candidate?
Well, it's very difficult, and this is part of the thing that the industry has done, because if you go to a financial advisor and say, well, how do I know you're any good? They're going to give you the spiel. But the truth is, it's a quantitative industry, investment management. It's all math. But yet, when you ask them, are you any good? They tell you everything but any kind of verified returns or verified investing skill. So, this is my suggestion. Find somebody you work with, and whatever you do, check them out on brokercheck.org through FINRA. FINRA is the regulatory
Like the
agency,
compliance.
the
Mhm.
compliance people. Check them out on finra.org, and it's called BrokerCheck. The other thing I would suggest, and I really mean this, and I'm not trying to be alarmist, spend the $100 and put them through a criminal background check. We have found out
Mhm.
recently that some of these advisors can actually go to FINRA and get their records expunged and
Oh, wow.
and on their forms, if they decide that it is not material, they won't put it on their history. So
Mm.
do an independent check, for lawsuits and criminal behavior. Do that yourself, spend the money. My last
Mhm.
suggestion would be, since we can't figure out who's good and who's bad until a financial advisor check gets up and rolling, is make a deal with your financial advisor. They have expenses and they are like any other small business. But there is absolutely, and I mean this from the bottom of my heart, there's absolutely no reason to pay them a percentage of your assets. It is a completely illogical way of doing business. It used to be okay when you were getting charged 10, 25 bucks, to buy a stock. Now you can do it for pennies. So
Right.
treat them as you would an accountant or a lawyer. Ask them for an hourly fee, and you'll probably have to pay some sort of upfront expense. And I say that because they have compliance they have to put you through. There's a lot of things that are front loaded when you bring a new client in. So pay them $500 and $200 an hour after that, something like that.
Mm.
But whatever you do, do not pay them a fee on your assets. It is the biggest drag on your fund performance, and it makes no sense whatsoever. When the plumber comes up to your house and something's broken, they go, "No, that'll cost 125 bucks." They don't go, "Well, we're going to charge you, 1/4 of 1% of your house value." Yeah.
Right. How do you even do that though? If it's a company, right? You mentioned quite a few names, at the beginning, and that's their policy is like we just charge a percentage of your assets. How do you even get them to change that? Or do you have to find someone who's like an independent who maybe works with a lot of different funds but doesn't work with a particular agency, per se?
There are a lot of independents out there. There are a ton of independents out there. If you can't find somebody who will stick to those rules, which I consider to be they are not restrictive to the financial advisor making money.
Mhm.
They are restrictive to the financial advisor's firm kind of abusing the fee scenario. Go to somebody else. Just
Mhm.
leave. Say, look, I understand, but you haven't proven to me your investing skill yet. I'm not gonna pay 1 or 1.5% to somebody until they prove it to me. And if you can't do
Mhm.
that, that's okay. We put out RFPs all the time. And this is like an RFP. And one of the requirements is that I pay you, let's say, an upfront cost for onboarding me. And then after that, it's an hourly figure, period. If you
Mhm.
can't fit that, then you're just going to have to, not apply for the RFP. You're out of the
Right.
pool, you're out of the universe. The great thing is small business people are really good for sticking up for themselves. And
Right.
this is one of those cases. They got to stick up for themselves. You
Mhm.
wouldn't pay an accountant a percentage of your gross income for figuring out your tax liability. Don't pay a
Right.
percentage of your assets to a financial advisor who hasn't even proved if they are skilled in investing.
Mhm. So if you're going to pay someone hourly on, a monthly basis to manage your finances too, how do you know what's reasonable? So when you're getting that bill, you know it's not like they're adding extra just to make sure that they're making enough.
Well, I think that's going to kind of go back to anything. It's not specific to the financial advisory industry. Any lawyer or
Hmm.
accountant can do the same thing. But I will say this, and this is not a knock on financial advisors or the industry. It's just a kind of a characteristic of financial advisors that they typically have a limited universe of go-to funds and ETFs or stocks. So once the initial onboarding takes place, uh, if you're spending more than 4 hours a year on it, I would be shocked. Unless they
Hmm.
are a seven-figure account with needs for estate planning, those things for the business where you need to plan for the people to take over in the future.
Are you talking about where you're going to offload your business and you're doing your exit planning
Right,
strategies?
right. So all of those, whether it's a financial plan, whether it's an estate plan, whether it's a plan to turn your business over to your friends or family or sell it out, those are all things that a financial advisor does and should be compensated for. And that would go partly into that hourly figure. And that's the great thing about financial advisors is that they are going to make you aware of issues that you probably haven't thought of. And that's why
Right.
spending a few $100 an hour probably actually saves you money in the long run. So your
Right.
first year with a financial advisor, I would say most definitely going to spend more than you would the second or third year. And at the end of the second or third year, that's when you really want to take a look at their investing prowess and say, okay, this person's pretty skilled at investing. We're going to stick with them, and then maybe switch to a fee of assets model. But in the beginning, I
Mhm.
would beg you, hourly, 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 hourly. And if they can't fulfill that, move on to the next one. There's also one other thing about financial advisors that's really good. And that is, not only are they going to teach you ways to protect your assets from creditors and put retirement plans into effect for small business people, which typically, the vast majority are unaware of how these methods work and how these processes work, but they also serve as a guide to the community. When you call this guy up and say, hey, do I do this, I'm a printer. And if you have any printing jobs, et cetera, let me know. If you have any clients, let me know, because now you're tapping into their client base.
Right.
So if you're a small business person, financial advisors can be a great source of assistance, with you personally and professionally. That's part of their job. That's
Exactly.
part of their job description.
hmm So how do you know then when you're looking at performance that they're doing a good job if they're the ones generating the financial reports, right? And it looks like you're doing well, like, oh, your numbers are up, great. Like how do you
Exactly.
actually judge that?
Yeah. So you can't. So I'll give you two tricks in the financial advisor sector that they do. The first one is on when you are with a firm, they have reporting software. And reporting software typically allows you several versions to print. And one of them can be maybe 10 pages long, one of them can be 20. But financial advisors typically pick the thickest one they can. And they want to just give you this book because it looks like they produced something when all they really did was push a button. And why do they do that? Because they know you're not sophisticated. And so you're going to walk into the annual report. They're going to put this 1-inch thick report down in front of you. 99% of all the clients are going to look at it and say, look, I don't want to read this. Just tell me what it says. This is why I hire you. And what's the advisor going to say? If they made money, the advisor's going to say, hey, we're doing great. We made money. And if the market went down, the advisor's going to look at them and say, well, the market's down. What are we going to do? You lost a little bit. So the answer is, and this is for 99.99% of your listeners, if they have under a $10 million account, there is absolutely no way for them to figure out if their advisor is skilled at investing or not, period. That's why we created Financial Advisor Check.
Wow. That's
Sorry to put it that
important
way.
to know. Right? Yeah, because like you said, I mean, we know the market goes up and down. You look like over time, you know that your value is going to continue increasing if you stay in the market long term, but I think this is like news for a lot of us though, too, is, we think maybe we're doing the right thing and now we're learning maybe we're not, right?
Right. I'll tell you the biggest one that gets me is that they give you returns all the time. If you go into hedge funds, they don't have a chief return officer. They have a chief risk officer, because typically the way professionals investors look at investing is they are exposing a bulk of cash to a certain level of risk. And that's very different from the way Main Street looks at it. Main Street looks at it as, well, if I put my money here, I should generate X returns. Professionals, no. They say, if I put my money here, I'm exposing myself to this level of risk. And then they try to reduce that level of risk by whatever they can. So
Right.
when you look at the charts they give you and they say, this is you here, and this is where the S&P 500 did, and this is what the bond market did, and maybe this is where 60-40 did, all that's great, but it doesn't make a hill of beans difference because you didn't invest in the S&P 500. You didn't invest in the bond market. You didn't invest in a 60-40. You invested in the risk model that they provided you at the very first or second meeting. Because whenever you go in, and I'm kind of showing my age here, back when the internet bubble burst and Wall Street got sued to high heavens, the lawyers took over. I mean, they really took over, because no longer could a client of the firm or even a prospective client of the firm speak with a financial advisor and not be asked to fill out a risk profile. And a risk
Mm.
profile is basically asks you, how much do you want to make over the long term? When do you need the money back? When are you going to start taking money out? And how much can you lose before it really hurts you and before you get emotional damage? And those three questions are asked in a bunch of different ways, and they result in a pie chart. And that pie chart might have, 40% of it might be in S&P 500, 20% of it might be in small cap growth stocks, and then you might have some municipals and some in investment bonds and some in the emerging markets or gold. But it all adds up to 100%. That's your benchmark, not the S&P 500, not the bond market, not a 60/40. And that's why when they put your portfolio up against these other indexes that do not mimic you in risk or return, they are just trying to provide you information without providing you any information that you can use. So they give you all the information, they give you tons of information, and then they try to make the adjustment saying, look how much information I gave you. That equates to transparency. And it's the furthest thing from the truth, because it actually equates to obfuscation because it's not relevant to you.
Right. Well, my question was going to be, how do you then get that information where they're comparing your risk to, what it should be doing versus the S&P? Like, is there another report within that they can easily generate? Or like, how do we figure out what really our risk tolerance, was, and then how did we do with that?
They could, not all of them can. Some of the bigger firms do have the ability to actually create a report that meets GIPS, and GIPS is Global Investment Performance Standards, and they are set by the CFA Institute in Charlottesville, Virginia. And basically they say, if you want to be GIPS compliant, there are 7 rules you have to follow. I think it's 7, 6.5, 7. Well, the reports that are typically generated by retail firms for Main Street at best meet 2 or 3 of them. Now, could they meet all 7? Yes. But this is a sales-oriented industry, and they don't want to compete on performance. Could they? Can you go to your Merrill Lynch guy and say, something, I want a GIPS compliant report? They can budget and tell you that everything in the report is GIPS compliant, but that doesn't mean the report as an entity is GIPS compliant. It gets really technical. And some of the things, truthfully, wouldn't be useful to a retail investor. But if you can do this, this is the one thing I would suggest. You tell your financial advisor, I want my annual report run against my asset allocation model, that pie chart that you gave me when I first signed up with you. That's the benchmark, not the S&P 500, not the risk-free rate, not the bond market, not a 60/40 portfolio. Run it against my benchmark. And they should be able to do it. Not all of them are going to be able to do it. As a matter of fact, I'd say the majority will not be able to do it, but some can. But they will tell you why it can't happen, I promise you.
Okay. So if, we hear, all the time too, the market is up, the market is down, and people are panicking now because, this is happening. And so, the market's going a little bit crazy. So is that something to really be as concerned about then? If we are supposed to be looking at, our own allocations, does that still have a major impact? I guess, should we worry? Should we not worry when we hear that news?
That's a really, really good question now, but maybe not for the reason you intended. When you take your risk profile at the beginning with your financial advisor, chances are you like the person in front of you, you're in a good mood, everything's wonderful. Well, there's been a lot of studies that show from a psychological point, they call it behavioral economics, that maybe you should take that test when the market's crashing too. And maybe take it, when the market's up, when the market's down, maybe it twice a year to arrive at a more efficient risk profile of how you feel. Of course, when the market's crashing, everybody, I know people that will not open up their monthly statements. They just throw them straight into the trash. They won't do it. But it's a really important point that you brought up, because when you create a risk profile, chances are your mood is pretty good. You're relieved that you're getting a professional to do it. You're feeling good. They have every reason, and they should do this, make you feel confident. They should. They're a professional. But is it an accurate representation of your true risk profile? So your point is very well taken. When you fill out your form, fill it out again when the market's tanked and you're not feeling too good, or maybe when you're angry with your performance. And your financial advisor will understand this, and they'll respect you, because it's actually to their advantage to get you to not be as risky. They're to pull you back from the cliff. Put on a couple of pairs of wings, think you could jump off a cliff, and that's not the case. But yeah, that's a really good question. And that's the first time I've gotten that. And you just hit on something that's really discussed in the highest circles of investment management on the retail side.
As someone who is super experienced with this, helping those of us who, maybe know a little bit, but not really all that much, like, are there any other piece of advice or tips or something you can help us to know what we should be doing when we're thinking about our investments, our risk, that we want to take, or any of that, to help us really do better with the investments that we already are doing or maybe thinking of getting into?
Sure. Well, of course, the first one I'm always going to say is buy my book, Wall Street's Grand Deception, available on Amazon. That's Wall Street's Grand Deception. And it gives you really a peek behind the curtain of Wall Street in wealth management and the differences that you find on the institutional side versus the retail side. The one thing I would say, please avoid, and most people do this, is don't believe anything you see on social media. Please stay away from all that. I've probably read more white papers on wealth management and investing than anybody you've ever met. I actually love it. I'm kind of a geek that way. I have spreadsheets all over the freaking place. And most of the things I see coming out of Wall Street marketing have a kernel of truth to them, which means they have a hefty handful of deception to them. And the one thing that drove me crazy, and bet you'll remember this. Do you remember the saying that all the Wall Street marketers were out there doing, saying, well, over 96% of your return is going to come from your asset allocation model? That came from a Brinson Biebauer study back in the 90s, and it's not what it said. It just isn't. It's not what it said. To be real specific, it said the variation in returns will come from your asset allocation model, which means nothing to the average person on the street. And it only means something to professional investors because they're working with billions of dollars, and they put decimal points out to 6 places because it means thousands and thousands of dollars to them. So Wall Street marketing is basically, and there's no regulatory authority that really oversees it until somebody complains. And by the time they complain, they'll say, oh, we'll take it down and we'll take a fine. When I don't want to say the firm's name, they're still around. One firm took in hundreds of millions of dollars on a completely deceptive ad campaign, and they got fined big time by the SEC, but the fine added up to their annual mailing budget, what they paid for stamps each year.
Oh, wow.
Yeah. So the SEC,
That's nothing.
Yeah, SEC and Wall Street have a pretty much revolving door back and forth. Don't believe marketing. The other thing I would say that people don't think about is if you have an advisor that's come from another firm, or your advisor's transferred to another firm, you better find out real fast if there was any value attached to that in the form of stock options, in the form of a forgivable loan. I have seen, and it is very common for advisors to get poached by other firms. It's the common way of building branches right now, is to poach financial advisors. And what they will promise them is, if you hit these benchmarks with revenue, the loan we give you will be forgiven. Okay. The problem with that is the advisor usually turns to higher revenue generating products in order to meet those benchmarks. And if they can't hit those benchmarks, your advisor's out in the street. So it is, to me, in my case, and this is completely subjective from what I've seen in my career. If I had a financial advisor jump firms, and the reason they did it had nothing to do with the previous firm was fine. They often say, well, I don't have access to the products I really like to use. Yeah, lie. If the first firm had no regulatory problems, I would not leave them, because the new advisor at the new firm, when they left over there, I promise you there was some sort of dollar signs dangled in front of their eyes, and I would be suspicious of the recommendations then on out.
Yeah, I mean, it's good for us to know because we don't necessarily know what we don't know, right? So it's good to have this conversation. I'm sure there's so much more that we could talk about. And of course, we're running out of time. So I do want to have you just share how our listeners can connect with you if they have additional questions.
Sure. You can go to financialadvisorcheck.com. We are on all the social media, TikTok, Twitter, Facebook, Instagram. It's Financial Advisor Check, and Wall Street's Grand Deception. Buy the book. I promise you, it's got great reviews from, I'll go ahead and say it, but there's a guy out there named Jim Grant, and Jim Grant's been around for a long time. Everybody on Wall Street knows Jim Grant. He has an annual conference that costs, I can't afford it. It costs thousands and thousands of dollars to attend. The who's who of the globe attended. It's his conference. This guy would be on the Mount Rushmore of Wall Street business economic journalists. He called my book very terrific and a public service. So I got to give myself that pitch. That he wrote me a note this week and sent it to me. So I'm riding high this week, I got to admit, Candy.
Perfect. Well, thank you, Norman, for being a guest on my show and sharing your expertise in this area. I really appreciate it.
Thank you. It was wonderful. Have a wonderful day.
Thanks. And to the listener, thank you for tuning in. Hope you found this discussion interesting and enjoyed how to properly vet your financial advisor. If you have any additional questions or comments, be sure to reach out to Norman at the link that he shared, or send me a message at media@abandp.com. I hope you can join me for my next interview. And remember, you can connect with me on Twitter, Facebook, and LinkedIn. And my website is abandp.com. You can also find the podcast, Biz Help for You, on several favorite podcast platforms, including iTunes, Google, TuneIn, Stitcher, iHeartRadio, and Spotify. And would you please share my show with those you know and leave a review on your favorite platform? I'd really appreciate your support. Thanks so much. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.